earnings season kicking into high gear this week, and the reporting season started strong last week with the major banks. Last week, Bank of America posting much better than expected results, sending the stock higher. Earnings per share coming in at 85 cents on revenue of $22.87 billion as the company saw growth across its business lines. Joining me right now is the chairman and CEO of Bank of America, Brian Moynihan. Brian, it's great to have you this morning. Thanks so much for being here.
Maria, it's great to be with you here from London, actually, and you can see a wonderful view behind your studio here.
Yes, thank you so much for being here while you're traveling. Brian, look, it was a great quarter. All of your lines of business showing growth. Tell me what drove the quarter, what you took away to be the most important driver of that growth.
Well, we grew revenue year over year for third quarter last year, third quarter this year by 12%. And kept expenses flat at $14.4 billion, basically the same number of expenses. So obviously had a nice rise in earnings. What drove that was more loans, more deposits, strong investment banking revenue, strong wealth management revenue across the board, and good trading revenue. All the things that we do across the board, all the businesses had good operating leverage in them. And it's really a normalization economy and a continued drive by Bank of America to win the market, no excuses.
Yeah, and you are winning the market. Brian, let me ask you about loan demand. We've been waiting to see loan demand pick up as an indicator of what's going on out there. You saw it. Is this a turn? Do you feel like things have finally begun to change with regard to loan demand?
Yes, if you think about it, from last year's third quarter, this year's third quarter, our loans are relatively flat in the core businesses. But going in the first 3 quarters of last year, you had a surge in borrowing around the pandemic and the issues related to it. Then the pay downs came, then PPP came in, and now that's being forgiven. So, but what we've seen is from the first quarter, the second quarter, the third quarter this year, consecutive quarters where the loans stabilized in the first quarter, started to grow in the second quarter, and then capitalized that growth in for the third quarter. And we grew, almost a double-digit core growth rate in loans annualized for the third quarter, which is strong. So what does that really mean? That means our customers are borrowing a little bit more. That means the economy is reopening. The economy continues to grow, and all that's good news for America and for the world.
Yeah, but it's also your leadership. I mean, one of the key things that you've been able to do, not just over this pandemic, but over time that you've taken over for the CEO position, was de-risk this bank. After all of those acquisitions under your predecessor, you put safety above all else after that tumultuous couple of years around the financial crisis. So tell me about the theory or the sensitivity now at the bank. Are you done being in the safe corner? Are you ready to take on more risk? Has the notion changed among your managers in terms of where things go from here with regard to risk?
Well, we take a lot of risk every day. We have a $900 billion plus in outstanding loans. We have a 700 balance sheet with Tom Montag and the trading team in the market every day. So we take a lot of risk and the operational risk to run the great franchise and take care of all the customers. All that's there. But when you really think about it, when the pandemic hit, of course, everybody had to hunker down. But the great news is because of all the work the team's done, we had great capital, great liquidity, and we are able to not only serve our customers and provide what society needs from us, deferrals on loan payments, surge in borrowing in the corporate sector, driving people into the capital markets for the larger corporate sector, keeping the wealth management customers understanding the market. All that happened while we were going through the pandemic, like all your viewers are too. But then what happened is we basically turned all the underwriting back on really in the latter part of last year and the first quarter of this year. We went back to the standards we had pre-pandemic because we could see that we had gotten through the risk. And what that really enabled us to do is for about $25 billion year to date, provide great returns and also return in this quarter alone $12 billion of capital to our shareholders because we're so well capitalized. So yes, we're taking risk. Yes, we're driving risk. Yes, things happen every day that we work and drive harder. But on the other hand, we're producing the kind of earnings and returns for our shareholders allow us not only to see the stock price get up, but also to repurchase a lot of stock and continue to share the benefits with our communities, our shareholders, and our teammates.
So is this a priority for you now? I mean, it's been a priority already, but going forward in terms of returning money to shareholders via buybacks and dividend increases?
Yep, it's been a priority continuously. So this was my 48th quarter as CEO. We've said the same thing since the beginning. Basically, we had more capital than we needed to serve our clients, and all the rules changed, and all the adjustments came in, and none of it's gotten easier. It's just as hard now in terms of capital levels and stress testing as we had in 2010, 11, or 12. So the rules have gotten tighter. We've been able to manage it well. But when we are done at the end of the day, we always want to spend our capital growing our business, because that means our clients are growing and we're with them. But even with the growth of almost a double-digit loan growth this quarter, year-over-year 12% revenue growth, we had excess capital, and we've been returning to shareholders, and that helps us reduce the share count and get the dilution out from some of the deals a long time ago, and continue to drive forward. So it's always better to use the capital to grow the company, but when you grew the deposits year-over-year $300 billion, and you're growing the loans at double-digit annualized in the third quarter versus the second quarter, you are doing what you need to take care of the clients. There's just a lot of capital left over.
That is incredible. And no wonder the stock is up, what, 50% over the last year. Brian, I want to get your take on pretty much the positioning going forward, because I know you always take on risk. You have to take on risk. But I guess a few months ago, you announced all those changes in terms of the management team. It appeared to be 25 of top middle management team changes. And some analysts are looking at that as perhaps representing a change in the operating philosophy, that now you'll be taking on more risk and now putting that sort of safety aside, whereas that's where you were for so long after the financial crisis, and really de-risking the bank after all of those acquisitions from your predecessor.
Well, the reality is we made management changes due to the fact that people retired. So Ann Fanuc, our vice chairman, is going to retire at the end of the year. Tom Montag is going to retire at the end of the year. And they're at the stage in their careers of working lives they wanted to retire from day-to-day active management at Bank of America. Andrea Smith's going to retire. And that set, of course, a series of elevations and a series of changes, really putting in place a management team for the next 10-year run. And that's what I've said to people, is we have to be prepared to drive hard, because the competition's fierce. There's lots of new types of competitors out there. There's the old competitors we've always had, and we win against them, but we have to have a team that's got a long view ahead of them and drive shareholder value and for a long period of time. So last summer in the 20, we started putting people on the management team, getting ready for the day when we knew that just because of people's personal decisions in life, they were going to change, and then we had to adjust to it. So we're all done with that. The new team's in place, and we're off and running, and we'll still drive responsible growth like we've always done. These teammates are the same teammates that actually did all the work. Tom and Ann and I and others, are their managers, but they do all the work and have driven the company and done it successfully. Matthew Coder in the investment bank, corporate investment banking, Jimmy DeMara in the trading business, Andy Sieg and Katie Knox in the wealth management businesses, and across all the commercial businesses. Just a great team of people who've grown up in the company over the last decade, really doing good business the right way and generating great returns for our shareholders.
Well, you've done a great job, Brian. I want to get your take on the macro story, these supply chain issues weighing on markets ahead of the holiday season, bottleneck issues, labor shortages, making it hard for supply to keep up with demand. Even as inflation is becoming a real issue, we've got a Wall Street Journal survey this morning showing that economists are expecting these issues to continue well into the new year. What's your take on how that slows down the consumer? You've got a great vantage point and have reported terrific consumer spending up until now. What's your take on what's ahead given these issues?
Well, I think let's start out from the broadest point, which is the macro view, which is our research team, and focus on the United States growth because that's going to help drive the whole world's success. Our research team, which is the best in business under Candace Browning's team, they have this year the high fives, between 5.5% and 6% GDP growth for 21, and then for 22 they have it between 5 and 5.5, 5.2 to be precise, and then for 23 it goes back more to trend growth. So what is that telling you? That's telling you that the economy is as big as it was nominally as it was in 19 before the pandemic. They expect to grow at twice to 3 times the rate for the next couple of years. So that's a pretty good place to be. Now, what could derail it? All the things that you were going through quickly, Maria, are all the things on the table. Now, what do we really see in the consumers at Bank of America today? Well, through the end of September, they were spending at 10 or 12% faster growth rate than in 20. You say, well, Brian, the 20 was a pandemic year, but no, 20 was bigger than 19, and it's over 20% over 19. So the spending is bigger, it's growing at a faster rate, and if you see in the first couple weeks in October here, we're seeing the same thing. So the consumers in the game and spending, the customers have in their bank accounts, especially in the $2,000 to $5,000 range, average deposit balances. So think of people who maintain that balance on sort of a constant basis. They have 3 times more money in their deposit accounts than they did before the pandemic. So there's lots of dry powder in those customers' accounts to spend, to do something with. The question is, will the delays in shipping and will the delays in shipping not only ships, which everyone talks about, but also the trucks you mentioned earlier and other means of logistics, slow down the spending. And the reality is you're seeing people spend it on experiences and goods, and it'll shift around, and we'll see what happens. But all that could get in the way. But right now you're seeing wage growth strong, spending growth strong, the economy is predicted to grow strong. And I think the key is to make sure that the inflation stays under control, and I think the Fed has made it clear they're going to start moving. And then secondly, get to work on these bottlenecks to help the free flow of goods, because those goods coming out of China and other places into the U.S. by the biggest, most powerful economy with the most consumer-led economy are important. And also, frankly, we have Europe growing at 3% this year, next year, which is also good because that means that big consumer-led economy can also participate. That's all good for the world. So I think all those bottlenecks have to get straightened out. But I think the American consumer is pretty good at doing what they do, which is spend money, and you're seeing them shift more to experiences and travel. Even with gas prices going up, they're still driving more miles. All this is good news for the economy, but we have to be careful those elements you talked about don't get in the way.
Yeah, and that Europe story, obviously great for Merrill Lynch and your wealth management business. But, Brian, you also stand out for your digital capabilities. You've made this a priority, investing in digital and the mobile economy. Am I right that 43% of consumer loans came from the digital channel? Versus 27%. I know the analysts were very impressed with your smile charts, that things are moving up again. Tell me about the charts as it relates to digital, and what kind of capabilities do you want to see over the next 5 years at B of A?
Well, we have been since the iPhone came out, for example, we've been embedded in it as an app way back. And so we've seen our digital users grow well over 40, almost 41 million users now, active digital users using the activity. We've seen the digital sales get to 44% of all the sales. But importantly, they're rising to 1 million plus sales a quarter now. And so they're becoming a significant part, 1.6 million sales a quarter in terms of number. I think it was this past quarter. So it's sort of half the sales of all the consumer loan products and deposit products. You see it in the Merrill Edge products. That you can see the hundreds of thousands of accounts we form. But importantly, it's also the way customers interfaces. So this past quarter, the third quarter, we had 2.6 billion digital interfaces between our customers and us. And so what's happened in the pandemic is you've seen acceleration of the usage across cohorts that were using it pretty well. And that's been good. And so you're seeing the numbers go up. But the basics are still going on strong. We're down to 15% of checks deposited at Bank of America by people handing it to a teller. All the rest are going through either an ATM or the phone. Those are important things for us to become more and more efficient and, frankly, spend more time helping customers with their day-to-day financial lives and the things they need to do, as opposed to just depositing a check because they can do that on their own. So part of it's really the fun stuff. We have 5 million users of our Life Plans product, 4 million active last quarter. We have Zelle, which is growing very fast. And already is a major way people pay people in the enterprise. We have Erica, which is a virtual digital assistant that tens of millions of customers use. All those are wonderful things, but you also got to get the basics right, which have great teammates in our branches serving the customers every day, and the team's doing a good job of that. Great financial advisors in Merrill, great private bankers in the private bank, and likewise with the commercial bankers. And so it's a high-touch, high-tech, but we've been very encouraged by our digital capabilities, and we're a big digital company. I mean, 2.6 billion digital interactions last quarter alone is a lot of work, and the team's done a great job of doing that.
And the technology is attracting new customers. I'm sure it's a great growth story. Brian, let me move over to regulation and the changes that we may see, because we know that the Biden administration is pushing to pass legislation that will require banks to report every $600 bank transaction of every customer. It's causing some real privacy issues. This proposal is facing pushback across the board. Even Treasury Secretary Janet Yellen is defending this proposal. What's your take on this proposal? What are you going to do when and if this law takes effect?
Well, being a regulated institution and being subject to the laws of the United States, if Congress passes a law, this is a matter of policy, and Congress has got to decide what to do. We'll all have to follow it, all the banking industry. As you look at the debate, the industry and our clients and Chamber of Commerce and others have made their positions clear. But in the end of the day, we have to follow law if it becomes a law. So it's a policy decision for Congress.
Yeah, well, we'll see what that means for the industry. I know that you're trying to protect people's privacy, but at the same time, there's not going to be much if, in fact, that does take place. Also, banking groups are united in terms of pushing back against some of this nominations for Biden's pick for key regulatory posts. I want to put on screen what Senator Toomey recently said about the nominee for OCC, the comptroller of the currency, rather. He says, I've never seen more radical regulatory nominee than Saleh Omarova. Your thoughts on whether or not we're going to see the banking sector face a much tougher regulatory backdrop, Brian? We know that Elizabeth Warren is out there saying she wants to break up the banks.
Look, our company's been around since 1784, so it's gone through a number of changes in banking with a second charter back in the Hamilton days. So, we've lived through all different types of environments, and we'll be here again tomorrow doing it again. It's our job and the management team's job to manage all those. And the pendulum swings back and forth. And I think, look, at the end of the day, the banking system is a great thing for America. It is one of the reasons why our economy can be so big. The ingenuity, the capabilities. It's one of the industries where we have the best participants on a worldwide basis. The competitors, the key competitors I compete with in the United States are the worldwide leaders in this industry. And so if we want to have a big economy and we want to have a successful economy, we want to have capitalism be strong, you're going to have you need a strong banking system. And I think we just proved that last year when our banking system was able to, because of the capital, liquidity, and capabilities it had, to step up and, in our case, do $70 billion of loans almost overnight, do 500,000 PPP loans, do 2.5 million customer assistance programs, and then do all the other work to also keep 200,000 people and their families, which is 600,000 people, safe and taken care of in this pandemic. And all my colleagues did the same thing. And so our industry is very strong and has done great work, and it's the reason why America can be a strong economy. So I think any idea to constrain that is probably not the best idea for the long-term success of America.
Yeah, I would have to agree with that. That's for sure, Brian. All right, real quick before you go, you're seeing your competitors surge into China as much as they can. I know that 8 years ago, as part of your de-risking process, B of A sold its remaining stake in the China Construction Bank. Do you see B of A re-entering the China market, either through a partial or majority ownership of a bank in that market, Brian?
No, we are in China today with a team that does corporate investment banking and markets, both in Hong Kong and in mainland China, and we're helping the largest companies in the country do things, and we're helping American companies and companies from Europe and the rest of the world do things in China. That's really our business model, frankly, anywhere outside the United States. And so the China Construction Bank investment was a great investment for us, but it was a strategic relationship where we helped, as the company went public, helped them develop their policies and procedures and banking systems, and help them figure out how to become a huge bank that they are. They're a very successful company, but our role in China will be around those types of activities. And so we have the charters we have and how we do it will be left to day-to-day activity. But the reality is it's large companies and markets in China, and by the way, it's the same in Europe, and by the way, it's the same in Africa, and the same in Latin America. We do this consistently outside the United States. Inside the United States, the opportunity for consumer banking, small business banking, wealth management is so huge that we don't need to try to find something to do outside the country. We have enough. We grew our deposits $300 billion or some number over a year. We have $1.4 trillion in consumer and wealth management deposits alone in the United States. Yet our market share is only 13, 14% in broad consumer, and we can grow that significantly. So outside, in China in particular, it'll be a focused strategy, which we think produces the great results for us and our clients.
Well, it sounds like you've got a long runway, Brian. Thanks very much for sharing the story with us. It's good to see you this morning.
Good to see you, Maria. Thank you. Have a good day.
And to you. Brian Moynihan is the chairman and CEO of Bank of America.